Namaskaram. We are starting with the chapter Overview of Model Tax Conventions. First of all, please try to understand some terminology here. Convention means treaty or agreement that we sign with other countries, foreign countries. And model means you can say a framework, a standard format. So why do we need a standard format? That question might come to your mind. So far as India is concerned, now India is having DTAA agreements or information sharing agreements, information exchange agreement. So please understand, it is having with more than 100 plus countries. If you are a citizen of India or you are a resident of India doing a business in multiple countries, don't you think it will become very complicated for you to understand the different treaty at a different time with a different country? All the time you are reading a new treaty and every time law is changing very frequently, the understanding is changing, the phrases are changing, the articles are changing, then it will become very complicated. Now think from the companies like Google, Facebook, your Honda, Coca-Cola, PepsiCo, who are having almost global presence. With every country they are having some kind of business transaction. For them it would have become very difficult to interpret and apply the global taxation or international taxation. Therefore, to have a standard format, some standardization has to be there. So this particular standardization was done by OECD versus United Nations. Okay, these two models we are going to learn in this whole chapter. OECD model of Model Tax Convention and United Nations model of Tax Convention. So these two organizations have given a standard format. One of the format will be adopted in applicable circumstances. Yeah. So sir, why do we sign treaty? You know that this answer you already have. Obviously to avoid double taxation, isn't it? Double taxation avoidance agreement. The second purpose of the tax treaty, now the latest objective of having a tax treaty is avoidance of double non-taxation or tax evasion. You should understand, or tax evasion. We are going to avoid tax evasion. We have to eliminate all this thing, isn't it? We also have to eliminate double taxation. There should not be double taxation based on countries source rule of taxation and residence rule of taxation. One individual or one organization is liable to pay tax in both the countries on the same income. That should not happen. Therefore, originally DTAAs were signed. Apart from these three major intentions of double non-taxation, double taxation, and tax evasion, to avoid these three tax point of views, we have to sign the treaties with many foreign countries. Apart from that, exchange of information, developing the economic and trade relationship, enhancing the business relationship, all those other factors are also involved in treaty. So definitely treaties are very important and they are very significant for the businesses who are having a global presence or multinational model of business. So whenever we talk about treaty, there are two models that you have to learn. One is OECD model and another is United Nations model. Okay, so OECD model of tax convention and United Nations model of tax convention. What is the difference? So some basic difference I'm telling you because I have not covered that theory in my presentation. See, I am trying my level best to reduce the content. Yeah. So I'm in this chapter also I'm taking the content which is only and only exam oriented. For knowledge oriented, you have to study international taxation at very expert level, advanced level. From examination perspective, that is not needed. We are going to learn only exam oriented focus syllabus. So I have deleted so many paragraphs and pages from the study material which are not that relevant for our examination. So OECD model and United Nations model. First of all, what is the full form of OECD? The Organization of Economic Cooperation and Development. This model is adopted by developed nation. Please understand, whenever there is an agreement between one developed nation to another developed nation, they will follow the OECD model. Whenever there is an agreement between developed nation and developing nation, please understand, whenever there is a agreement between developed and developing nation, they are going to follow United Nations model. Obviously, you can guess India is not a member of OECD. India is a member of United Nations. In OECD model, there are 38 developed countries which involves USA, Germany, Mexico. So many developed countries are there. Almost every developed country must be there. And in United Nations models, we are having almost 194 countries. Please understand, that means almost a globe is covered under United Nations model, including developed countries. Developing countries are also there. So this OECD model is applied when you sign the treaty, when the treaty is getting signed, say for example USA and Germany. When treaty is getting signed between USA and Germany, they will follow the OECD model. Whenever treaty is signed between India versus USA, or India versus Canada, or India versus Germany, then obviously they are going to follow United Nations model. We are going to follow United Nations model. So this is the main primary difference between these two. The most important another difference, if they ask in examination what are the primary difference between OECD model and United Nations model, one question is there. So you have to tell first of all it is applicable to this developed versus developing. Second point is, in OECD model, the focus is on, please understand, residence rule of taxation. Residence rule of taxation meaning thereby, sir, if there is a confusion in jurisdiction of the tax, in which country particular income should be taxed, so country of residence will be given the priority according to OECD model. Every country want their own, want to tax their own residents. Whoever is resident in Germany, tax on their income, not only on their domestic tax on their international income, global income will be paid in Germany itself. So they are focused more on residence model, whereas United Nation model of tax convention is focused on source rule. Please understand, this is focused on source rule. What is the logic, sir? Why this is focused on source rule? So let's have the logic behind it. See, country like India needs lot of resources for development. Countries like Germany, Russia, they are already developed, so they may not need the resources as compared to developing nation. So whenever they sign the treaty between two developed nations, obviously they wanted to prove the dominance, and the country of residence will be, having authority to tax the income. But whenever there is a developing country involved, that means according to United Nations model I'm talking about, and here another developed country is involved. Let's take example of Germany. So when Germany is doing business in India and he's a resident of Germany, so from Indian perspective he is a non-resident. Obviously the source is located in India and therefore income is taxable in India, and according to the residence rule of Germany's taxation, it will also become taxable in Germany. Now India and Germany will sign DTAA, and in DTAA they have to give either tax to the source country or residence country. If this both were developed nation, definitely the tax would have gone to Germany, but because it is between a developed and developing nation, the preference will be given to India. The source rule will try to give more tax to the developing nation, because many developed nations are having their businesses in India. Countries like India, obviously I'm talking more about India, because in examination if they target the question, they will target the question from the Indian perspective. So I hope you understood this. Why is it favored? Okay, in United Nations, the more preference is given to the source rule, because sources are located in developing countries. So whenever developed countries earning income in India, you need to remember it will become taxable in India in most of the cases. It need not to be standard, because this is just a model. This is not a final document. Final document will be signed between the two countries representative. When they sit together, they will discuss, they will negotiate, and according to the negotiation, this agreement will be signed. So it's not a final, but it is kind of a draft agreement, you can say, which will be signed between two nations. Now, without wasting much time, let us start with the articles. There are 32 articles in OECD model, and there are 31 articles in United Nations model. Majority of articles are having common language, and some of the most important articles are only covered in our study material. So whatever is there in our study material, I'm going to cover only that much. Scope of the convention, scope of the treaties, or difference between the treaties. So article 1 talks about person covered. Sir, who can take the benefit? Now obviously if the treaty is signed between two specific nations, so either resident of India or resident of Germany can take the benefit. A resident of China will not take the benefit of a treaty which is signed between these two nations, isn't it? So article 1, that is section 1 of this particular whole treaty, covers what? Resident of CS. So who is CS? Contracting state, the states which are signing the treaty. For application of a treaty, a person has to be a resident of one or both of the contracting state. So he has to be either resident of India or resident of Germany, or he can become resident of both the countries, but definitely a non-resident in both the country will not take the benefit. Fiscal transparent entity. So what do you mean by fiscally transparent entity? Transparent entity means some of the countries, please understand, in India, holding company and subsidiary company are treated as two different entities. But in some of the developed nations specifically, if there is a holding company which holds 100% shares of a subsidiary company, we don't consider them as a separate entity, we consider them as a transparent entity. Similarly, one more example you should remember, partners and partnership firm, please understand, are treated as a separate entity in our Indian income tax law, but globally they consider partnership firm as a transparent entity, pass-through entity, and therefore there will not be any taxation in the hands of the firm. The tax will be levied directly on the partner's income. Okay, but in India it doesn't happen like that. In India we take tax from the firm and we give deduction, lot of deductions and benefit to firm, and then we also take tax from the partners. Obviously we have taken care of double taxation, so there won't be double taxation, but yes, we treat them as separate entity. So look at this. Fiscal transparent entity, income derived by or through fiscally transparent entity under the tax law of either contracting state to be considered to be income of a resident of a contracting state to the extent such income is treated for the purpose of taxation for that state as the income of the resident of that state. So the focus is on resident. Please understand, whenever there is a transparent entity means if subsidiary company is there in India and holding company is there in Germany, then please understand this whole income, because this is just a transparent entity, it will be taxed in the country of resident. In the country of resident, that means where this entity has established its business or it is registered. Next one, Article 2, taxes covered. Now, I'm sure that you have not studied all this model tax convention, OECD model, United Nations model in GST or customs. That means in indirect tax, you did not study this. So, sir, whether these particular conventions are applicable to direct tax as well as indirect tax? So, answer is no. These are not applicable to indirect tax. This is only applicable for direct tax. But in direct tax, sir, there will be tax on income. Yes, so tax on income is covered. So there will be tax on investments. Yes, sir, tax on investment is also covered here. There will be tax on other income like dividend and dividend and interest and other sources. Yes, it will be covered here. There will be tax on capital transaction. Capital transaction means either investment transaction or capital gain transaction. Please understand. So on that also capital taxes are also covered here. You know that in income tax law we are having 5 heads of income, but that is the Indian income tax law. In foreign laws it might happen that for revenue income they might have different act, and for capital income they might have different act. So this particular treaties are covering capital taxes as well as revenue taxes, but only direct taxes, not indirect taxes. Taxes on income and capital. Capital means you can also understand it as an investment in India. So capital transaction, you know that when you transfer the source, it will become taxable. The model tax convention or model convention apply to taxes on income and capital imposed on behalf of the contracting states or its political subdivisions or local authorities, irrespective of the manner in which they are levied. So the manner might be different, the name might be different, but it has to be a direct tax. Okay. Coverage of taxes. Taxes on income and capital covers. Okay, please understand. On total income, that means tax on gain from alienation of movable property. Alienation means transfer of movable property. In India, it is known as a capital gain tax. On total capital, please understand, taxes on total amount of wages, salaries paid by the enterprises. So even that is covered here. Income from salary, you know that in India it is known as income from salary. On element of income or of capital, taxes on capital appreciation. Capital appreciation means whenever your value of investment goes up, that it can also become taxable. So these are the 2 first articles we have discussed so far, and please have the clear-cut picture in your mind. We are not going to discuss all 32 OECD conventions, OECD articles and 31 United Nations model. No, not 32 and 31 models. We are going to focus only on important articles which are applicable for examination. Thank you.